Okay, so welcome everybody. This fine Saturday morning, we're going to be going through this new model that we've developed and will be coming out in Oxford Economic Policy on endogenous monetary policy credibility, and it's designed in a way where you can consider a little economy operating with a larger economy like the United States. The specific application that we're going to be going through today is going to be about the US and the Euro area during the period of COVID and so on. So Annie Asoyan, who's been heavily involved in this project and was a co-author on the Oxford paper, is going to be starting. And then thanks to Heike Sigitsia, who's got everything up and running in Diner Julia, he's going to be showing us how we can actually use open source software to solve everything that we did when we were developing the model for the paper. So Annie, please.
Thanks, Doug. Hi, everyone. So as Doug said, we are going to present this model, which includes endogenous policy credibility in it. Let me share my screen and continue. So this model that we are going to present is included in the paper that's going to be an Oxford paper. And the whole idea of the model is that credibility of central bank is endogenous by nature. So if we go back to the history of post-pandemic events, we can see that the summer of 2021 has vividly highlighted the dangers of relying too heavily on baseline assumptions. So in this period, we can clearly see that many central banks have faced pretty heavy stagflationary forces, including Fed. And for the most part, they were really reluctant to address to these shocks because many of them firmly believed that these forces were indeed transitory, including Fed also. And this hesitation to take decisive actions has cost them their credibility, and so the inflation expectations, inflationary forces have embedded in the economy. And it became evident in higher sticky prices and increased neutral rates, as you can see in this picture. Critics like Larry Summers have addressed this hesitation, saying that indeed this hesitation of decision making cost central banks their credibility, and as a result of that, they made their job harder to re-anchor expectations, making inflationary forces to intensify. I also want to highlight Mervyn King's remarks about having the need for models which incorporate credibility of endogenous nature. So the idea is that credibility is not something which is exogenously being given, but rather it is based on central banks' own actions to meet the policy objectives. Indeed, this speech was made recently in May 2024, but the idea of credibility dates way back, and we can see here the evolution of the literature. This is we can see a considerable amount of literature has been dedicated to this idea of ENDOCRED and the credibility and endogenous credibility since 1993. So I will present this last paper written by Haigas Igitian, Shalom Khadrishvili, and Douglas Luxton, which is going to be Oxford paper. So why credibility is important to the central banks. We can see from historically that loss of credibility can result in severe consequences. It can worsen inflation and output trade-off. It can be embedded in higher inflationary forces in the economy and increase unemployment rate. We can take an example of Bank of Israel's case in the beginning of 2000s. After the bursting of dot-com bubble in the face of a weakening economy, Bank of Israel tried to stimulate the economy by decreasing the interest rate. So by the end of 2001, they decreased the interest rate by 200 basis points in order to steer the economy. And this transferred to the exchange rate, through the exchange rate channel, to the inflationary forces being intensified. And as a result of that, shekel has depreciated, which is their currency. And so inflationary forces accumulated and intensified. And by the mid 2002, by the July 2002, it reached about 7%. But Bank of Israel was hesitant to take decisive actions in this period, and only 5 months later, they increased their interest rate by 450 basis points. And this hesitation raised skepticism around public about the true intentions of monetary policy being conducted by Bank of Israel. And because of this skepticism, this shekel, their currency, depreciated even more because of increased risk premium. So they had to keep a tight monetary policy stance for an extended period until the mid 2003, about 9% of interest rate, raising interest rate about 9% to curb these inflationary forces in the economy and re-anchor expectations. So this is a period of low credibility. You can see that it required from them to have increase interest rate for an extended period, to keep these high interest rates for an extended period. As opposed to that, I want to bring another example of the same Bank of Israel's case from different periods. This is in 2006, where they faced similar stagflationary forces, stagflationary shocks due to the high oil prices and their currency being depreciated. But however, we can see that as opposed to the first episode, in this case, it didn't require much from them to re-anchor expectations and to bring back inflation to the target. Although we can see that inflation even exceeded the upper bound for some time. So because of accumulated some credibility in this episode, they managed to bring inflation around the target and to anchor inflation expectations in less amount of time. So this, you can see here clearly how credibility works and why credibility is important. And in our models, we usually we are saying that credibility can be seen as a stock, and it is harder to build and easier to lose, and you can lose it instantly, but building it requires a significant amount of efforts and time, but there are also some exceptions to this rule. Take an example of Bank of England's case. In May 1997, when they achieved their independence and had a stronger monetary policy committee with a clear inflation target and objectives, and they managed to increase their credibility in pretty short amount of time, and so they managed to to anchor the inflation around 2.5% in less amount of time. So let's go through the model. Model consists of two parts, linear and non-linear parts. This is the monetary transition mechanism. This is a rather simpler representation of a much more complex mechanism through which monetary policy operates and through which monetary policy influences inflation and through which monetary policy influences the economy through prices and interest rates. But here we omit a significant complexity, which is known as endogenous money creation. So in this endogenous money creation assumes that a central bank doesn't have a direct control over money supply, and as opposed to the traditional textbooks where they say that corporate banks issue loans from the pre-existing deposit accounts, they rather create money with issuing new loans, and by issuing new loans they automatically create a deposit in the borrower's accounts. So we have in this monetary policy mechanism, rather we have these the idea that a monetary policy has broader influence. So the monetary policy, the influence of monetary policy exceeds beyond the current setting of the interest rate, which is being decided on any given decision day, because borrowing decisions made by households and firms are not only being influenced by the current interest rate, short-term rate, but also the expectations of future interest rates. And because of that, we incorporate long-term, you can see long-term effective interest rate, which is acting as a weighted combination of interest rate across various maturities. And we, according to the expectation theory, we define these various interest rates as the average of the expected short-term rates plus corresponding risk premia with the same maturity. We also have the exchange rate channel here, where the exchange rate is not only being driven by the fundamentals or by forward-looking dynamics, but also includes some historical patterns or backward-looking dynamics. And because we have the semi-structural model, our model allows us to be this flexible to include backward-looking dynamics as well. And we have this inflation forecast-based reaction function, where the inflation forecast, namely three-quarter ahead year-on-year inflation rate, affects the policy rate. So these reaction functions performed relatively well in case of the moderate times, like great moderation period. But when we enter to these extreme cases, the dark corners of the economy, which are characterized by high and volatile shocks, the performance of this reaction function becomes limited. So that's why we also incorporate nonlinearities to capture these nonlinear effects where the linear model fails to capture adequately. So the first nonlinearity includes convex Phillips curve. You can see this is being implemented by the output gap term here. And intuitively, if we move towards this Phillips curve, if we start from the right part of the Phillips curve, where the output gap converges to its maximum level, usually estimated to be 5%, this is where economy operates above its potential. And in this case, inflation accelerates. And to delve deeper into the intuition, I suggest you to read George Evans' paper about the bottlenecks, where he explains that because firms hit the bottlenecks or their capacity constraints, it transfers to the wages and then intensifies inflationary forces in the economy. So as an example, I can bring 1970s inflationary forces, which was characterized by stagflationary forces and monetary policy missteps, as well as post-pandemic events where due to the high demand going on in the economy, it transferred to high and volatile inflation. If we move towards the central part of the Phillips curve, we can see that as the output gap is near zero, Phillips curve becomes rather linear, and it describes moderate output and inflation. And this can be an example of the great moderation period from the mid-1980s till the offset of global financial crisis. And in the left-hand side of the Phillips curve flattens, and this is being described by low inflationary pressures. And so this is relevant for countries like Japan or those in euro area who suffer with challenges like a low inflationary trap or zero lower bound. We can we know historically that after global financial crisis and their debt crisis, Europe has suffered this low inflationary trap for more than a decade until COVID pandemic took in. So next nonlinearity is the loss function. Here we can see that central bank penalizes the deviations of inflation from its target. Also, the wild swings in the interest rate to ensure the smoothness of the policy rate path. And we also have output deviation from its potential to ensure that the business cycle is smooth enough. So how much central banks want the pace of the inflation converging its target depends on these coefficients of the components. And if we take an example of Rogov's conservative central banker, which despises inflation, then we will give a rather higher weight to this first component, which will ensure that inflation will converge towards the target in less amount of time and pretty fast. So this loss function is actually, in general, it is symmetrical. But if you consider some specific cases for specific countries like US, we can think of asymmetric loss functions because we know that Fed has this dual mandate and it cares about unemployment as well besides inflation. Then we would rather have negative output gap rather than just output gap in general to ensure that we are penalizing only negative deviations from the potential. So now let's finally move towards the credibility and see how credibility is being modeled. So credibility enters to the model by affecting inflation expectations directly and determining the weight placed on the past versus forward-looking information. So this is the expectation formation, and you can see that expectations have both forward-looking and backward-looking component. We want to make sure that even in high credible environments, expectations are still backward looking. So some of these expectations are still being developed by some historical patterns. And so the credibility is defined as the coefficient of the forward-looking component. So when credibility erodes, when it depreciates, two kind of processes are happening. First, inflation is being more persistent, and then inflation expectations are ratcheting rather upwards or downwards. So we capture this effect, the latest effect, by including this inflation, these bias terms in the economy, in the model. So these coefficient kappa high will be obviously greater than 0, and kappa low will be negative. Now let's see how expectations are being formed in more details. So we consider two kinds of distinct processes here. First, where expectations are formed like optimistic yet watchful way. So in this case, people put a positive weight on the idea that inflation will converge towards the target, say 2%, but also they take into account historical patterns as well. So next kind of expectational dynamics is being called skeptic and history driven. So here we assume that inflation that public expects that inflation will will diverge from the target, and it will converge to a value that is either high or low, either higher than lower than the target. So in the high inflationary regime, we assume that inflation will converge to a 5% inflation. And in case of the low inflationary regime, we assume that it will converge to minus 1% inflation. So here, credibility is being modeled in a way that it becomes depreciated even when inflation goes below the target. And this is because of the countries. It is relevant for countries like Japan or those in Euro area. So any deviation from the actual inflation from its expected value will be the error term, forecast error term. And you can see those are the deviations being depicted in the picture. So with using these error terms, we define all of the probabilities of entering either high or low inflationary corners or dark corners of the economy. So those are those dark corners are famously being described by, famously being mentioned by Blanchard, who tried to describe the global financial crisis by then. And these probabilities are being defined as the share of the error terms during the skeptic expectations relative to the whole share. So the idea is that when actual inflation converges towards the target, then we can see that the error term made by skeptic expectations is shrinking. In the extreme case, when this inflation aligns with the target, we will see that it becomes zero. So error term becomes zero in the numerator, and in both cases, we will have that probabilities of entering to these dark corners will be zero. On the other hand, if the actual inflation diverges from the target and moves towards these either high or low inflationary values, we will have that the forecast error terms are made in these skeptic expectations, made by the skeptic expectations, are decreasing. And in the extreme cases where they are too close and to these inflationary high or low inflationary values, we will have that these error terms become almost zero. So we will have that either here either one of these forecast errors becomes zero, and then this second term, for example, sorry, here. The second term in this denominator will be equal to zero, and so numerator and denominator will be equal, and then the probability of entering to the dark corner will be 1. So besides that, we also introduce some conditions which says that if inflation materializes in a way that it is lower than the expectations made for high inflationary regime, then the probability of entering to this high inflationary regime will become zero. This is pretty intuitive, because if we have that our actual inflation is lower than our expectations, skeptical expectations, then there won't be any chance to enter to this dark corner of the economy. And on the other hand, if inflation materializes in a way that it is higher than the expectation formed in the case of low inflationary regime, then the probability of entering to this regime will be zero. So we consider two kinds of credibility processes. A flow of credibility, which is defined as the inverse of probabilities to entering to these dark corners of the economy, which is pretty intuitive. As the probabilities of entering to these extreme cases increase, we will have that our credibility is being deteriorated. And this flow of credibility captures these short-term dynamics in the credibility. We also define the stock of credibility, which is based on the historical values of credibility and also the flow of credibility. And this stock of credibility enters to these expectational dynamics. You have seen this earlier. This is the first equation that I have showed you. So it affects expectations directly by being the basically being the coefficient of the forward-looking dynamics. And we also have these inflation bias terms. These are being defined by the probability of entering to the high inflationary regime or low inflationary regime. And either one of these probabilities can be above zero. So if one of them is above zero, the other one will be obviously zero, and inflation expectations will ratchet either high upwards or downwards. And in the perfect case, when we have perfect credibility, those probabilities both will be zero, and we won't have any inflation bias terms. Okay, so Here we use 10-year bond rates, the expectations from the 10-year bond rates, in order to construct this credibility. And so we have done this for the United States and Euro area and compare the periods for pandemic. So we can see that in the pandemic case, in the pandemic period, Fed spends less amount of time less amount of time and efforts to re-anchor expectations. You can see that compared to the Euro area, United States inflationary expectations are being re-anchored in less amount of time. And compared to the ECB's credibility, Fed has accumulated more credibility than ECB. On the contrary, Euro area's job is hard. ECB's job is harder to anchor inflation expectations, because we can see that their credibility also has been deteriorated for way before than the COVID period. So now let's see how this, why this credibility is important, and particularly when this importance is becoming relevant. So we will consider two kinds of times here: normal times and economic turbulent times. So in the normal times, if we have like a negative shock, for example, negative demand shock, the rational response from the central bank will be to reduce the policy rate in order to steer the economy. And thus, inflation expectations will increase, and it will result in the decrease of the interest rate path. So as a result of that, because of the capital flight, exchange rate will depreciate, and it will stimulate the economy. So this is the mechanism through the UIP condition. You can see that as the interest rate path decreases, this depreciates the currency, and as a result of that, we have easier monetary conditions, both from interest rates and exchange rates. And in this normal time, exchange rates and interest rates act as shock absorbers. So they will absorb a part of the negative demand shock. On the other hand, if we are in the economic turbulent times, like high inflation or low inflationary environment, these are the dark corners. If we move towards these dark corners of the economy, then we can consider two cases. If we have credible central bank, which has this credible active policy, and if, for example, we are at the zero lower bound, and we are encountering with a negative demand shock, then central bank loses, it runs out of the monetary policy space to operate. So it can shift to using alternative instruments, alternative unconventional measures like quantitative easing, forward guidance, or even fiscal stimulus. And the result will be similar to the previous case. Inflation expectations will increase, and this will decrease the path of the interest rate, depreciating the currency and steering economy. On the other hand, if we consider the next case where our central bank is not credible enough and it has perceived passive policy, then we will encounter hardships here. And so the central bank cannot operate with its conventional policy measure like interest rate because of the zero lower bound constraints. Also, it cannot operate with unconventional measures as well, because it will be ineffective because of the low credibility. So both of these instruments will be ineffective to use, and as a result of that, this will increase the real rate and currency. So inflation expectations will actually go downwards, and it will increase the real interest rate, and currency will appreciate. We will have that these economy constraints will make the exchange rate and interest rate as shock amplifiers. So in this case, they will amplify the consequences, negative consequences of the negative demand shock. And this is where credibility is important. In case of high credibility, central bank can manage to shift to using these unconventional policy instruments instead. But if we do not have enough credibility accumulated, then our policy will be constrained in both ways, in conventional, or in case of conventional or unconventional policy instruments. So there is a similar example of a shock amplifier. This is the case of euro area during the pandemic period. So we can see that as opposed to the US, euro area enters to the pandemic period with low inflationary expectations already. So for the US, inflation expectations in this case are about 1.5%. But for the euro area's case, it is 0.8. So for both countries, inflation expectations have been deteriorated, but in case of euro area, it is way lower. And when they enter this pandemic period, these inflation expectations continue to decrease in case of euro area, and because ECB has spent for an extended period, they have spent on the zero lower bound, starting from the global financial crisis, from their European debt crisis. They entered to this low inflationary trap, and they were on their zero lower bound. They also lost significant amount of credibility to operate. So as a result of that, when they entered to this pandemic period, they were constrained and couldn't operate with their conventional and unconventional measures. And on the contrary, we can see that Fed has managed to re-anchor expectations in less amount of time by operating with both instruments, and they weren't constrained by using their unconventional measures as well, because they have accumulated significant amount of credibility starting from the 1980s, from their Walker disinflation period. So as a result of that, we can see that in this case, euro has appreciated, and this resulted in further contraction of the European economies. We have used this model to replicate this scenario. This is the June 2020 mock simulations for US and Euro area. So you can see these two economies enter this pandemic period with different initial conditions. So Fed has almost perfect credibility in the beginning, about 0.9. But ECB's credibility is 0.7. And also we have incorporated depreciated inflation expectations as well. So inflation expectations in the case of Fed is 1.5, and for the euro area it is 0.8. And we can see that Fed spends less amount of time on being on the zero lower bound than ECB, and Fed manages to re-anchor inflation expectations in pretty fast pace compared to the Euro ECB's case. And and we can see that this Fed can permit the further decrease of credibility and affirm that credibility kind of balances in some value, but rather than that, we can see that ECB's credibility continues to decline. So this is the whole idea of credibility. In fact, credibility is important in every period, all the time, but its true value is becoming apparent in case of these economic turbulent times. So we also have used this model to illustrate some case scenarios. This is for the US economy as of November 2024. I know some of these scenarios have changed since then, but some relevant cases are continue to some cases are continue to be relevant. So, for example, this market reference scenario that we consider. Still market expects soft landing to happen. If we go to the Atlanta Fed's market probability tracker, we can see that they, although the neutral rate has increased, but still they expect a soft landing. On the other hand, we illustrated case A scenario. So compared to the market reference scenario, in this case, we require to have higher interest rate path to curb inflationary forces. And in this case A scenario, we can think of factors like the relevant demand story that is still pretty relevant as of now, because since the pandemic, there was a massive increase in asset prices and household wealth, and it transferred to the demand story, increasing the consumption. And also recent policy shifts by the government. They plan to impose tariffs, immigration policies, restrictive immigration policies, also tax cuts. All of these policy shifts are to be stagflationary, and they pose upward risks on the inflation and create case A type considerations. On the other hand, we have case B scenario. In this case, central bank requires to have lower interest rate path than what is priced in the financial markets to achieve the objectives. And in this case B scenario, we can think of scenarios like events like asset price corrections or Chinese economic further slowdown. So most of these increase of the asset prices are indeed because of the bubble, and we think that this bubble can burst anytime, and these case B considerations are relevant as of now. And we also constructed case X scenario, which is the extreme case of the case A. And in this case, we assume that Fed will follow this soft landing for a while, as you can see, looking at the Fed funds rate. And then after realizing its mistake, it will try to re-anchor expectations because while it started to follow this soft landing rather than having a decisive policy to increase the interest rate. This has made inflation expectations going upwards, and inflation has spiked, as you can see in the case X scenario. And because of that, because of delayed policy action, they have to increase the interest rate well higher than in case of the case A scenario. And in this case, the federal funds rate have to be more persistent. This increase has to be more persistent. So this is it as of now. Thank you so much. If you have any questions, feel free to ask.
Yeah, I just want to clarify a few things. First of all, can you go back to the to that little table that you had where you can be constrained by the effective lower bound? This one, because the way that you described this, it was almost like credibility, and you actually mentioned high inflation, dark corners kind of thing. I think, and so I want to draw attention to that, but I want to explain it a little bit differently. If you have a framework that doesn't take into consideration the effective lower bound, okay, it means that you won't have instruments ready to go when you lose the policy space when you're constrained by the effective lower bound. So that's why you don't have credibility because you don't have a framework that has the instruments to, that can be adjusted sufficiently because you're constrained by this effective lower bound. So I think you want to make it clear that it's not credibility that's creating that problem. It might be exacerbating that problem, but it's because of a lack of a framework. And then I think you're absolutely right, Annie, that this also works on the upside, okay, in the sense that if you got into a situation where financial markets thought that you couldn't raise interest rates above some critical threshold, say because um, you know government
Of
debt
this-
and private sector debt had gotten really, really high and so on. So I think that's what you were trying to say, but I just think that you need to elaborate that the effective lower bound is like a real constraint, and it's because of the lack of having a framework that has instruments ready to go. There, I would have maybe also added that if you're a small open economy, you can always use and you have the legal authority to purchase unlimited amounts of foreign assets. That effective lower bound should never really be a problem whatsoever because you can always depreciate the currency sufficiently to prevent people from thinking that you're going to get stuck at that effective lower bound and so on. So, but I like that. You also said something that got me thinking right at the very beginning, which is maybe you can go back to the very, very first chart on interest rates and inflation and so on. And what you said there actually I found quite interesting because you said that one of the reasons why the neutral rate I think was not right here. I think what you said is one of the reasons why you thought the neutral rate had increased is because they underestimated it early on, um, and that's an interesting, little twist because what we would normally say is that the advanced economies, not Armenia, not economies where they they knew that their credibility was fragile. They raised rates about a year before the advanced economies. So this is, this problem that Mervyn King has pointed out about the advanced economies falling behind the curve because they presumed that inflation was going to be transitory. That is a problem with advanced economies, central banks. For many emerging market economy central banks that recognize that their credibility is fragile, they raised interest rates a lot further. But what I heard you say, Annie, is that the neutral rate, when you underestimate it, it might end up higher later because inflation expectations will drift up. So it sounded like the way you define the neutral rate included this inflation expectations. And I think that might be a very wise comment that you made there. Can you just look at the reaction function for a sec? I just want to look at it and try to explain it that way. Yeah, there it is right there. So if you define the neutral rate, okay, and it's completely up to you to do this, especially the nominal part of it. But if you define that neutral rate to be R bar, okay, which is the real rate, okay, plus inflation expectations, 3/4 ahead, and you go back to 2021 and you say, look, the advanced economies again. By the way, why were they suffering from groupthink? There's a nice little presentation by Tiff Macklem and Governor Powell, where they talked about when they go to the BIS, they all talk about the same scenarios, the same transitory scenarios that I would draw your attention to. But if you thought that they all had underestimated inflation expectations, which they did, okay, another way of thinking about that is that they underestimated the neutral rate if you define it this way. So is that what you were talking about when you talked about when you underestimate the neutral rate in one period, it means that and you lose credibility, you allow longer term inflation expectations to ratchet upwards, okay, and you get this kind of peso problem where people think that you might be going to 5% inflation. It means that the actual neutral rate later, the nominal neutral rate, will be higher because you made mistakes earlier on. Is that what you were saying? Because I'm
Yes.
just trying to, I was
Yes,
trying to, because I think that's profound actually, because there's a hysteretic kind of aspect to neutral rates. And you might say, well, if the Fed, is successful, the neutral rate increase, the neutral rate is higher for other reasons. Okay, I'm not trying to say that this is the whole story for why the neutral rate's higher because the neutral rate is very uncertain and people were just underestimated it. But they also might have underestimated it, and that might have resulted in it of them having to have higher rates for longer had they not underestimated it. And that'd be consistent with a lot of empirical evidence. For example, in the United Kingdom, they had to have higher interest rates for years between the time when they first introduced inflation targeting in 1992 up until May 1997, because they were constantly fighting stubborn inflation expectations and so on, and the chance that they might resort back to the good old days of the 1970s and so on. But anyway, I just was curious what you meant and just wanted to elaborate a little bit more and make sure that that's what you were talking about.
Sure, Doug. Thank you for your comments. Yeah, I at first I didn't I presented in more generalized way and didn't separate it by countries. But you're right. Those advanced economies they were very reluctant to respond to these increased inflationary forces. On the other hand, so this can also be because they were very kind of confident in their accumulated credibility. On the other hand, the small open economies, emerging markets, which had this fragile economy credibility, they were more risk averse, sorry, and because of that they took early actions on this battle against the inflation. And I can confirm that Central Bank of Armenia was one of the first central banks also to take these decisive actions towards these inflationary forces. And yes, because although this neutral rate is a very complicated thing, and it also includes other factors as well, but still these heightened inflationary expectations can also impact neutral rate to increase. And we see similar patterns even now. We can see that if you look at the Atlanta Fed's market probability tracker, if you go there, we can estimate that neutral rate is higher what Fed perceives it to be. So markets expect currently neutral rate to be around 3.8%, 3.7%. And what Fed think from their dot plot is about 3%. So still we can say that Fed might underestimate this neutral rate, and it can have severe consequences. But thankfully, recently we have seen that Fed took some decisive actions, and it refused to further decline the interest rate. And this is I relate to this positively, because taking into account that currently underlying inflationary forces are pretty elevated in the United States. So if you look at the Atlanta Fed's wage tracker and also sticky price CPI, we can see that they are pretty elevated. Although Fed's preferred core inflation is converging towards target, still we can see that those core forces, underlying forces, are above the target, about 4%. Also taking into account the potential implications from these policy changes, such as tax cuts, immigration policies, tariffs, they can further exacerbate the inflationary forces. And thus, this recent decision from Fed is pretty wise, I would say. It is better to take a moment to reflect on the economy, and rather than continue decreasing the interest rate. Also, about this other comment, I want to mention that you're absolutely right. At first, I described this in a more general way, because I wanted to highlight that this problem, these economic turbulent times, can arrive not only in case of the zero lower bound, but also on the other case, because this zero lower bound problem is relevant for economies such as Japan or Euro area, which have this challenge, this issue with the low inflationary trap. And they also have these structural issues. For example, EU has these nominal wage and price rigidities because of strong labor unions there, and they tend to go towards this low inflationary trap. So this is also relevant now, because nowadays their inflation is converging to the target, but these underlying inflation forces are still elevated, are still above the target. But what we can see is that ECB is decreasing the rates. So I can understand this in a way that they are afraid of entering to this low inflationary trap again. Although we have to take into account these underlying inflationary forces, which are pretty elevated. Still, I can understand that they might think that these inflationary forces might transfer also to the expectations, like a catch-up effect. And because of that, they can still enter to this low inflationary trap. And because of that, they are afraid of entering there to this dark corner. And that's why they are continuing to decrease their interest rate. But for economies like ours, which do not suffer from this problem, these are the small open economies and economies which are characterized by high dollarization. As you said, they can always depreciate the currency by announcing to buy unlimited amount of foreign assets. So. On the other hand, we have another issue, which is this going towards to this high inflationary environment, and we also can be constrained by the other reasons such as fiscal dominance. So if you look at these these interest rates being constrained by, on one hand, by effective lower bound or zero lower bound, and on the upside being constrained by this fiscal dominance, we can think of this as interest rate corridor. And this interest rate corridor theory says that different economies, based on their based on the issues they face, they can constrain either upside on the upside or on the downside. So on in our case, the second case is more relevant. So we might be constrained by this high government debt and then fiscal dominance, and might be pressured to keep the interest rate lower than what is needed to meet the objectives. That's why I have mentioned also that part, that we can think of these shock amplifiers, these economic turbulent times in other ways also.
Good. And can we just go back? So I just want to add a few points because we want to obviously turn this into like a professional presentation. So I want to give my comments now and so on. So can we look at credibility in the euro area and the US? Because I think this is one of my favorite slides here. So and you mentioned all these points. I just want to summarize. So the euro area for many, many years, I mean, going all the way back to the global financial crisis in 2008, experienced a period of systematic high unemployment, like economic slack that they couldn't get rid of. And in fact, the ECB, because they don't have an F-pass framework, Mark 1 or Mark 2, and so on, would actually produce forecasts. The staff would produce forecasts where inflation would not converge to the target, would actually converge to a number like around 1.5. And of course, they also, as a result of that, would tell people what policies were necessary to get inflation to converge to the target of 2%. There was some, problem, about the 1.9 and the 2, where some people thought the target was 1.9, but that's another separate problem. That was a result of not having a framework, an FPAS framework that thought in terms of what do I need to do with my instruments to achieve my objectives. But in addition, just producing a forecast that didn't go back to the 2% target was like shooting yourself in the foot and so on. So it's not surprising that in the first phase of COVID, when the shocks are contractionary, that long-term inflation expectations in the euro area continue to ratchet down given for years and years and years, the ECB was unsuccessful at getting inflation expectations at the 2% target. The Fed is different. The Fed fought a much bigger fight trying to anchor long-term inflation expectations. The average inflation targeting framework that Rich Clarendon, for example, designed was intended to get rid of those risks of deflation. All the FOMC members understand, have read, studied the Great Depression, and they do not want to be stuck in what we call a Fisherian deflationary trap and so on. So I think it's important to understand that going into COVID, the Fed had more credibility, it had a track record of using instruments very aggressively. And then, of course, during that first phase of COVID, used their instruments as aggressively as they've ever done in the history of the US, like, with the massive fiscal expansion and of course, taking the policy rate down to the effective lower bound, and again, bringing back large scale asset purchases and so on. So I just thought that, it's not surprising, given the lack of a framework at the ECB, number one. Two, given the experience of not having a framework for years and years where long-term inflation expectations were, substantially below the 2% target, that we observe what we observed here. Okay, so I just wanted to point that out. Japan, I think, would be the other side, would be a great example of the other side of this. They are in a really difficult pickle now, because if we go into the case A, the case X kinds of scenarios with higher interest rates in places like the US, that is going to put incredible pressure on the Japanese. They're concerned about the 160 yen. I mean, at some point they have to raise interest rates if global interest rates are higher and so on. So I very much enjoyed your presentation this morning. Does anybody have any comments or
Thanks.
questions, please? Lucasi? Thanks, Annie. Lucasi or Arut or
Meaningful comments.
What?
do you
May I
have
have
any
one
comments or
question, Doug?
questions, guys?
May I have one question, Doug?
Please, of course. Oh, everybody, please.
As I've seen in your slides for Israel country's case, and I want to know, how did they manage to increase their credibility in a short period of time, and overall inflation decline? You explain it just from the side of credibility. Is there any other forces there?
Yeah, so as I said, they were in a very difficult time in this case, in this period, because there was a skepticism around the public. The inflation spiked up to 7% by the July of 2002, and only 5 months later they began to increase their interest rate. So this delay has caused them even more loss in their credibility, and the risk premia increased, and it transferred to high inflation, depreciation of the shekel, and high inflation. So to curb these inflationary forces, to anchor inflation expectations, they have to maintain their policy stance, their tight monetary policy stance, for an extended period. So until the mid 2003, they had to keep their policy rate around 9%. You can see that until the till even after 2003, they still had high this persistent and high interest rate path. So they had to have this in order to re-anchor expectations. And you can also see that exchange rate and inflation, they for some time they undershoot the target, and this was inevitable because they had to do that in order to anchor expectations. So this contributed to an accumulation of their credibility. And the next episode, we can see that in this next episode, it didn't require from them much to re-anchor expectations and bring inflation back towards the target. Did I understand your? Did I answer your question correctly?
Yes, many thanks, Ani. I mean, if you can lose your credibility just 1 second, and regaining it again, it can take much longer or years. I mean.
Well, just two things. It did take years, okay, Harut, but you're absolutely right. Uh, it was kind of incredible that they still gained it so quickly because they had a fiscal crisis and so on. But there's a nice YouTube video that we did with Eddie Brender, who's one of the people in Israel. He's currently the head of the research department at the Bank of Israel, but he's also the leading fiscal expert on Israel, and historical expert, and so on. And you're absolutely right. That they lost their credibility by cutting rates, by 200 basis points. Country risk premium jumped, shekel depreciated, and that resulted in inflation expectations ratcheting up. We're not showing a graph here. I think it's in the paper about how much unemployment had to rise, and how persistently it had to rise. So there were pretty substantial costs, Arut, and it did take years to reestablish credibility. But you're absolutely right. Why did it happen so fast? And the answer is that it was a combination of good policies and good luck. Okay, in the sense that they had this fiscal crisis, so it was not just a monetary thing; it was the perceptions of fiscal dominance and so on. And what happened is after the breakup of the Soviet Union, there was a lot of Jews in Russia that were extremely well trained and stuff that moved to Israel. Okay, so you had that happening at the very same time that you had the tech boom and so on. And so that provided the combination of those two things really high potential growth. Okay, so it had sped up and helped to basically stabilize the fiscal accounts and so on. So the way that Adi Brender describes it, it's a combination of good luck and good policies. The way he describes fiscal policy is that they did just about everything wrong and then started to get it right gradually over time. So Harut, that comment that you made about how Israel became credible, it seems to be remarkably fast. And the answer was it was really fiscal. They managed to figure out fiscal, and they got really lucky by having access to Russian Jews that came in that had higher education, that were, and then of course the tech boom. They got lots of venture capital from the US and so on. So that's really the story of Israel. I'm hoping that we write that up actually. Azzy and I started to draft something like that a few years ago, and I think it's probably a good time to maybe tell the whole story about why they managed to sort it out as quickly as they did. But look, Cassie, you had a question or a comment or a root? Do you have a follow up?
No,
I
thank you,
had a
Doug.
yep. Good morning, everyone. I had a question about low and high inflation regime, especially high inflation regime. I mean, how how do we define high regime? I mean, do we look at the deviation from the target? How much is deviated, for example, inflation or inflation expectations, or how long is deviated from the target? Do we look at the deviation in terms of percentages or in terms of time? How do we define it?
Sorry, I didn't get your question.
So I did actually. So maybe I can answer it. So so the answer is both. Okay. The way that this model is set up, okay, you have to think about what you think is the relevant regime. Okay.
Hmm.
So you want to think you could have a 5% regime, you could have a 10% regime, you could have a really high regime. That's something that you need to decide. You're not going to be able to estimate those things, right? Because there's not enough data to do that. But so if you were thinking about applying it in an environment where you thought something like the 1970s inflation was applicable, you probably use 10%, or you might use kind of like what the previous peak in inflation was that you thought was in people's minds and so on. Then the next thing is to define, once you've defined those regimes that you think are relevant, is to write down an equation, like a forecasting equation, to calculate the forecast error after you conjecture you might be in that regime or you might not be in that regime. You might be in the regime that the central bank is trying to get you to believe that you're in, which is the 2% regime. So you measure, again, with that forecast error, how far away you are. Okay. But then it's the credibility, it's a cumulative sum of these forecast errors that matter for credibility. So the answer to your question is that both matter. The deviation matters in terms of measuring central bank performance, and that, of course, depends on what regimes you think are relevant for the period that you're currently in. And second, because credibility is a stock, it depends on the cumulative sum of those forecast errors and so on. Okay. Did
Yeah,
that answer your question?
yes, clear. Thank you.
So some of the questions, Annie, that Hike raised, he raised a whole bunch of questions about how you would think about it. And this sort of builds on what Lacassi just said about how you would think about setting up the model, for different countries, right? Because you would want to think about, obviously, what is the high regime? Do you want a 5% regime? Do you also want a 10% regime? So the model could be extended to incorporate all these things. But at the end of the day, you're going to need to have an economist that's sitting driving this machine, because you're not going to be able to estimate these models. We tried to estimate them, and there's simply just not enough data to identify all the regimes that you think that might be relevant over a particular sample. And so, in fact, the original earlier work was based on estimating state Markov switching models. And what we found is that as we tried to apply these state Markov switching models, you just couldn't estimate anything. It was simply just looking at a bunch of very misspecified models and transferring all those misspecification errors into state markup, switching art. In other words, some funny lines where things were jumping between 0 and 1 and so on. So this methodology is a pragmatic approach to trying to take on this issue, but it does require economists that formulate judgments about all these things, as opposed to economists that think that they can just give the model to the computer and get the answers from the computer. So just a note about what you need to think about. Have you responded to any Heights questions, Annie? Like thinking about, like, for example, how you might apply it differently to other countries?
Actually, I didn't have time to operate with the model, but as I'm delving deep into this ENDOCRED stuff, I will try to construct it with other features as well. And the question about these omegas, which was pretty interesting. I would try to like play with them and see what are the true meanings of them. So yeah, I'm in the middle of the process, I can say.
Just one quick question. Can I? Do you hear my voice?
Yeah.
So, when we calculate the probability of high regime and low regime, uh, can we say that that probability is the probability that either case A or case B scenario will be happening in a country or not?
Well, we consider this case A, this more hawkish scenario,
Uh-huh.
where like we have to it requires for us to have higher interest rate path than this market reference scenario has, than what is financial markets, what is priced in the financial markets. But for these probabilities, we think of the extreme cases like these dark corners of the economy that Olivier Blanchard has mentioned for describing the global financial crisis. And these dark corners, they are being characterized by a high and volatile inflation on one side and low inflationary trap on the other side. So if our case A, rather than I would say our case X, is strong enough to push us towards this right-hand side across the right-hand side of the Phillips curve, then we can think of them similarly. Yeah.
Thank you.
You could think about it. Okay, like where did inflation targeting come from? And so it came from, it's kind of amusing because the IMF talked about looking through supply shocks. I was like, well, where is this coming from? Like inflation targeting came from the problem of dealing with or not dealing adequately with the stagflationary shocks of the 1970s and so on, right? So the idea, I agree with Mervyn King, like the idea that people would be developing analytical frameworks that suggest that you could look through supply shocks. It's mind-boggling and so on. So you're right, Lacassie, in the sense that if you didn't have a framework like FPAS Mark II that had endogenous credibility as one little feature in it, then it means that you would fail to guard against the possibility of inflation expectations ratcheting up, and you'd be repeating exactly the same errors that you made in the 1970s. If you had a framework that failed to prevent inflation expectations from ratcheting downwards, like in the euro area and obviously Japan, not for years but for decades, then you would of course risk falling um, into into the both of those dark corners. One where you're continuously constrained by the effective lower bound, and you don't design a framework to get out of the problem, which again is not a problem for you guys in Georgia and Armenia, not a problem at all, because if you have the legal authority to purchase unlimited amounts of foreign assets, the Czech showed this in 2013 on November 7th, that you can always design an FX intervention strategy to eliminate the possibility of ever getting stuck in a low inflation trap. So you're absolutely right that if you didn't have a framework to deal with this problem, that thought in terms of case A, case B's, and X's. X's would be when you lose credibility on the upside. Y might be because you lose credibility on the downside and don't, come up with instruments that are sufficiently aggressively that you would expose yourself to it. So Mervyn King's right. I mean, all this work on DSG models and stuff that by their very nature ignore these problems. But the idea that the IMF would say that we should be looking through supply shocks is just completely bizarre, given the history of where inflation targeting came from. Completely bizarre. It's also, with reference to the ECB, and Annie mentioned this a little bit, because Lagarde said that she was very confident that the interest rate is above the neutral rate. And that's why I was thinking about Annie's point there, because the way that she defines the neutral rate might be a little bit different than the way that it's defined at the ECB. Because if you include inflation expectations in the neutral rate, and then and that's kind of a cute little wrinkle thinking about that way, because if you think service price inflation in the euro area is still well above what the target is, then you might also be concerned. I think Annie was right to say they should be concerned about falling into a low inflation trap, given the record that they've been in that trap for years and years and years since the global financial crisis. But they should also be concerned that inflation expectations might still be above the target. And when they think about that neutral rate, they should maybe think about that inflation expectation that's in that neutral rate calculation. So that's why I found that comment, Annie, so insightful, that I'm not so sure I'd be so confident to say that I'm very confident that the interest rate in the euro area, the policy rate is above the neutral rate, because the neutral rate might be higher if you believe inflation expectations is actually higher than what is embodied in the forecasts of the ECB and so on. So anyway, time will tell. But the euro area is in a difficult pickle because, I mean, as is Japan, because you have to worry about the low inflation trap because of the long history that you had suffered from that particular problem, and the fact that, if they do undershoot, then it would make sense that people believe, yes, they're going back into that, that dark corner again, where they'll be exposed to, vulnerabilities related to not having the policy space to deal with contractionary shocks, like during COVID. They entered it with their interest rate being much lower than the U.S., for example, which had managed to escape that low inflation trap, and as a result, the interest rate was much higher going into COVID, giving them a lot more policy space to deal with the first phase of the contractionary shocks. So I'm talking about, after February, March of 2020 and so on. Okay, so a lot of richness here Lots of risks on the horizon. I think in my mind, it demonstrates clearly, Lucasi, the important role of having a framework that guards against both low inflation traps and high inflation traps, that make sure that the framework incorporates sufficiently powerful enough instruments to deal with all those things. And at the point that Annie said is that make sure that that your instruments aren't constrained because of fiscal dominance, of course, which is going to be a real concern now, given extremely high levels of government debt. Just might not be possible for many places like Japan or Europe in particular to raise interest rates above, some critical threshold because of concerns about unstable fiscal dynamics and so on. So there's tons of work, tons of papers to be written here, including this whole idea that central banks should look through supply shocks, which is, and this is this DSG modeling stuff. I mean, unfortunately, it's Mervyn King is right. Mervyn King is absolutely right. People building these DSG models are doing it without really thinking very deeply about any of these issues. And Mervyn King's right. They in many central banks, they've been infected by this economics that has these crazy policy implications and so on. So I think it's a little bit sad, actually. It's not only that they've developed these DSG models, but they all developed them referencing to justify doing it all the other central banks that are building DSG models. So it's just groupthink at the analytical level that's bad, but it's also groupthink at the policy level, which is bad. So I think the profession is failing in capturing everything we know about history and doing evidence-based policy analysis by effectively incorporating fad modeling into policymaking institutions and so on, which is what Mervyn King is so upset about, saying that we need to have more models with endogenous monetary policy credibility. Okay, so any other? Yep.
I want to have a little comment on what you said. That monetary policy's role in this matter, it is very critical to have this framework to guard the excessive variability of the economy. It includes avoid overheating and also leaving room for the maneuver for the interest rate in downside risks. And I recommend to read this paper, the Bell and Laxton of 1997. About this, which really highlights this important role of monetary policy. And to understand these dark corners of the economy better, the George Evans paper might be pretty useful, 1985's paper about the bottlenecks and capacity constraints.
So are we going to shift now to HiCAS, who's been
yeah, but Ami, can you hear me well now?
Yep.
I think Ani already covered everything, so we can finish and go and go enjoy weekend. But yeah, let's start and do some work on on applying these models to address different issues as Anna described. The Oxford paper. In the rest of the course, I'm going to go deeper through this modeling system, two-country ENDOCRED, which will be published in Oxford Economic Review in March, I guess. Yeah, and currently we have the entire system working in Dinar Julia, which is very good. It's as you know, open source software, so we can share the codes and everyone can run and replicate the results of the paper, as well as to think about different policy issues and design their own policy simulation, as well as think about other modification of the ENDOCRED system. So it evolved over time. So as Ani showed, like last 20 years, DAG started this work on models, nonlinear models with endogenous policy credibility, and we have a bunch of different modifications of this framework. So we have ENDOCRED for closed economy. Looking at the US, we have two-country specification. We have ENDOCRED designed for small open economies. So we, like a couple of years ago, we tested it for Armenia at the early stages of developing the analytical framework of FPAS Mark II for Armenia. And now let's talk about two-country ENDOCRED, which Ani already presented, but I will go through the Dinar Julia codes and show you how to work with this kind of models, as well as some technical requirements. I will show step by step how to get Dinar Julia, how to install these programs, and how to make sure that you can run these kind of systems by your own. And I would like to ask you to be very interactive, because otherwise these formats of workshops will be very boring. So I hope you will interact. So parallelly you will run on your computers these codes, try to install all the necessary programs so we can be in line. So I'm going to start. We can do half an hour session, then go to short break, like 10-15 minutes, then come back and continue until 2 p.m. Okay. Who has Julia installed in computer and who can follow what I am doing? Ani, so Ani has, Lucas, Harvuk, Sophie.
No, I guess I haven't.
Okay, no problem. I will show how it's very easy. It's very easy to install, and so on. This good opportunity also for those who are not here, then watch videos and follow the entire process of installation and all these things. Okay. Let me share my screen. Yeah. Now let me close MATLAB. Can you see the screen?
Yes, we can.
Okay, very good. So the first stage of getting Dynar Julia is just open the julialang.org, which is the official website of the Julia, and here from downloads you can choose, are you using Windows or Mac or Linux, and download the package which will satisfy your computer's requirements. In my case, I guess so. I need this Windows installer, so I'm using Windows. For those who use Mac, can download this. So just download the installer. So during this session, I will ask you to share your own screen. So it will be very interactive, and so we can make sure that all of you and some of you successfully installed and do all the steps. So when you download this installer, so Julia currently so it's downloading the latest version. Currently it's 1.11.3, and you will need just to install this. It will take 2 minutes, no, not more. Okay. So who is doing now this? So only asking is DMG or TAR for Mac, right? Try DMG. I don't know. Probably DMG. Try DMG. Sophie, do you have?
Yes, I have Julia as well as the
VS Code.
Visual VS Code, but yeah, I don't have Julia in VS Code. Yeah.
Yeah. I will show how to get that. Okay. Who are at the early stage of installing this? Can raise hand or just talk. Well, let me install it. I have already in my computer the earliest version, but when you are running this installation, it says it chooses the directory where to install, then next, create desktop shortcut, create mod, and next. It will take a couple of minutes for the entire installation process. Yeah, installation success. It took less than a minute. So if you open the Julia software, it has this form. So now we have Julia, but you now like operationally this like using the single Julia is not very user friendly. So it's very difficult only in Julia, like to run the models and change, write down the codes. So you can do the basic whatever you want here, like simple mathematical calculations. So 2 + 2 = 4. It gives you the answer, and do very the advanced calculations. But this this format of working with Julia is not user-friendly. That's why we need some other software from which we can use all these features of Julia, all this computational power of Julia, but which will be much more nicer to work with code, especially with models which we are using for policy analysis. That's why at the second stage, everyone get this, Julia, or not? Can you run this? Can you open this, Julia, in your computers? Just let me know so I can continue.
I have.
Good, Annie. Okay, you are using Mac and you successfully installed, right? So you can run this in your, if you are using Mac as well. Then, at the second stage, we are going to Visual Studio website. So it's very simple. Just in Google, type VS Code. And the first one, just open this website, code.visualstudio.com. And from here, go to downloads, your code editor defined with download for Windows. Okay, it's downloading again. It's very simple to download, to install it, just 100 megabyte. Similar to Julia, it takes like seconds to install. Just try this VS Code. So again, similar to Julia, VS Code is also open source software. Everyone can download. We installed VS Code. Just let us know. Annie, you have? Annie,
I have
Yeah.
also installed VS Code.
you have, Sophie. Perfect. Yeah, that's very good. And at some point of time, I will ask you to share your screen so we can fix some bugs and other stuff. So each participant from beginning can, by watching these videos, can successfully do all the steps and finally run and do policy analysis with the models. So after the installation, if you open your VS Code, it will have this form. Of course, I am at some folders, and I will show you how to open and get that. But at the first stage, like how to link how to link Julia to VS Code. Here on the left-hand side, you should have extensions. If you open this, in your case, who is installing it for first time, I think you will have empty place. But in search extension, just type Julia. So this Julia, and just install that. Can you see the install button here? But install this Julia. Julia language support, Julian. Yeah, that's the first program we need. Ani has, so Sophie, just let us know.
Yes, I only installed it.
Yeah, Sophie, and you are using Windows, right?
Yes.
So you are using Windows, Ani is Mac. That's very good. Then the second program we will need. So the last I guess for so here in my case I have five programs. For creating the PDF reports with we need this LaTeX language support and LaTeX. Can you find this and install? We need all these five. So for running just the simple code in Julia without creating any reports, we need just this Julia. But in the future, you will need also this LaTeX and VS Code PDF, which is kind of creating the PDF reports. And I hope in the future, whatever I'm going to present, you will make that much more nicer, a very nice reporting system, because for you it will be much more easier than for me. You are very advanced in using like AI technology. AI can help you write down some codes for reporting. So I will be very happy to see that progress.
Sorry, Vikas, do we need all these five softwares, like extensions, to be installed in VS Code?
Yeah,
Okay.
I said just if we are running the simple model without any reporting system, we need just only Julia. But for the future, you will need also this LaTeX language support, Rainbow CSV. This is creating, it's saving your results in CSV format, which can be very useful. So then you can put these results in CSV, then create maybe your own your own figures in Excel, or pass the results of the model output to colleagues and others. And then VS Code and this LaTeX thing. I have this five. Installation takes seconds of this. I think you already have, right? Sophie has, and Ani,
Yes.
you have?
I have 4 of them, but LaTeX, I don't have it yet. It's just, it keeps installing.
Okay, good. Very good. Okay. If you have this, then the next stage, will be just creating some some folder, and I will share with you some codes just in your desktop. Just create something like this. Course February BPP, that was project February 2025 in your desktop.
Can you please send these codes as zip files?
I will send, of course. Just create some folder. in your desktop. And let me share some of the codes with you. Then during the course, I will share other codes as well. Let me put this in chats, and then after the session, we will circulate everything among participants. So this and ENDOCRED. Guys, just put these two codes into the folder you created. Okay.
Uh,
You cannot download from.
Yeah, neither I. Can you send it in
Yeah, of course.
email or?
Of course. Let me send to you, and then okay. Just give me a second. And I would like to ask Sophie or Ani to share desktop, so I can give you instructions and directions, so you can install all the necessary things, and then after having that and making sure that you are able to run the model. So then I start here and go through the codes and present to you specific features of two-country ENDOCRED, as well as to show some technical advances which Dynar has, and we can discuss that deeply. Okay.
As you can see, LaTeX and VS Code PDF is still installing. I don't know the problem. It takes more than minutes.
Just let's wait a bit, but I guess in Windows we already have, right? So
Can I share?
yeah, please. Mhm.
Okay. Mm. And so I have all 5 extensions installed, and I will. I have not received the email.
Yeah, just a second, please. Yeah, please check your email. I circulated.
Yeah. Thank
Did
you.
you get?
Yeah. Yes, I got it.
Okay, just now, Sophie, you have in your desktop or whatever you want, just create some folder, name it course ENDOCRED, something like that, and download these files into that directory. Okay.
Okay, like
But we can't see. We see only your.
okay, so
Yes. Please share your desktop.
yes, I guess now you should be able to see the desktop.
Yeah, now we can see.
Yes, like then I should go to Sir, open.
Okay, you have that in your folder. Then,
Yes.
yeah.
And then choose
Open
this.
folder on the left hand side. Yeah, open folder. Open that. Select folder.
Okay. So,
Yes, I trust the authors. No, again, go to file. No, just go to file.
new file?
No, on the left-hand side, upper. What you did just a second ago.
I just add the file.
And now we are at your in your desktop
Yes.
directory, but we need to go to course materials.
Okay.
Just go to file, Sophie, again. Not from there.
Stop, sul zemo trovare edited part.
Okay. This one?
File. Yeah. Open folder
Okay.
and go to your folder. Open that, select folder.
Yes.
Perfect. Now on the left-hand side, we see the current folder, which Sophie names it course materials. And we have these two codes, ENDOCRED simul and quarterly US EA. But the next stage will be to open in the command window to make sure that we are running the Julia. Can you type Control-Shift-P?
Control-Shift-P, yes.
And write Julia start REPL.
And what?
Start REPL. Yeah, that one. What it's doing, just on the right-hand side, close that to help me. Yeah. Okay. Now, what we are doing, we are linking via Julia to VS Code. So why we are using VS Code? Because it's very nice software. It's very user-friendly. So you can use all the benefits and the computational power of Julia, but work in a very nice software. Now Sophie has Julia successfully running in the VS Code, and also for linking Julia to VS Code, we added these extensions, VS Code specific extensions, which we did like 10 minutes ago. Now you can do the same operations as you can do just by opening the Julia, but now we need now to install other programs like Dynar, and differently from the MATLAB Dynar, here in Julia we need to we are downloading the Dynar from internet. Okay, so you can go to here GitHub Dinar Julia. GitHub.
Oh, okay.
Yeah, GitHub Dinar Julia.
This one?
Yes, please open this. So this so Michel Juilliard who developed all this nice nice toolkit to make our life easier. Created also this Dinar Julia GitHub page where you can find a lot of documentation and codes, instructions how to install Dinar Julia. So let's keep this open and go back to VS Code. We'll come back to this. I am recommending you for each your project to have some folders, and inside the folder install all the necessary packages, to work with your projects. Now, here, just put the right square bracket into. Yeah. So you should have this V11 packaging. And here, Sophie, now we are creating some folder where we are going to put all the necessary packages to operate with code. Type here activate ENV. We can call virtual environment. Activate
VNV?
ENV. Yeah. You can name it env, but just to be activate.
VNV. Not like this?
Space activate space VNV.
Okay.
ENV.
Like this.
Okay.
Okay.
Enter. Okay, it's saying new project that the link user software desktop course material VMV. Now, you can type here ST, enter. And it will say what installation, what packages you have in your VMV environment, okay? Now, because we haven't done anything, it says it's empty. Now, the first thing which we need to add, now how we are installing Dinar into Julia. There is a simple command we can do. Here type add space Dinar, D capital. Dinar, enter. So on the first time, it will take some time, but once you install this, then at the next time you just activate it and it's already installed. For the first time, it will take like around five minutes, and I think it's a good time if you run this at Dynar, so we go 10 minutes and have break and come back in 10 minutes, and then we will have Dynar and can proceed with other steps to run these systems. Okay, we'll come back in 10 minutes.
Okay.
can we continue? You're here. So very good. Sophie, you are here.
Yes.
I hope everyone here, and so we can continue installing all the necessary programs so we can then work with and analyze the features of the ENDOCRED using open source software, Dynar Julia. So now you what you did, you added Dynar software, right? And it took almost 8 minutes to complete, 470 seconds. And here, to make sure that it's installed successfully, just type here ST again. ST. So what it said, previously it was empty. Now you can see that we have Dynar V 0918. This is the version of Dynar. So when you are using Dynar Julia, it's automatically updating the latest version of Dynar. So it's 0918. Okay. Now then, it's not enough. We need other softwares to look at the properties of the model. And in the chat, I sent all the other all the other packages of Julia which we need. So first is data frames. So we need data frames and dates to be able to plot our results, our simulation results. And okay, so Sophie, you went again to Julia. Right square bracket, go to VMV environment. No, only the right one. Right square bracket.
Okay.
So what
sorry.
what's doing? Just the right one. Okay, we are here. Type again ST. Make sure what we have. Okay, you you downloaded the data frames as well. Then the next one, just add here plots. Okay, after installing each, just type ST to make sure that that it installed. Okay, now we have 3 packages, then dates. So these plots, dates, they are responsible for. They are not responsible for running and solving the model. These packages just responsible for plotting and analyzing, plotting graphs and analyzing the results. Then this path solver is very important thing, and it's a Dynar feature. It's outside of the main Dynar package, but path solver is responsible for solving the for doing deterministic simulation and for solving the mixed complementarity problems. And as you know, as also Ani presented, what we have here, Sophie. Again, add. Let's try path solver. Add PATHS, a capital letter.
This one, right?
Yeah. Let's see. I don't know what this failure means. Resolving, then failure, then downloading. But it should work. So what we have, can you go up? Can you go up in command window? Let's see what's the problem here. Unable to download install password from sources listed in. To be honest, I don't know. What is this? You get the same on you download it.
Mine is working.
Okay. Then can you go down again, type ST? So Ani successfully downloaded this.
Yeah, it does not have this path solver.
Yeah. Okay, Sophie, let's close this VS Code. Unable. Then we can search this error in internet, but let's first.
Or she can start again by this brackets and then activate VMV and then try again.
Yeah, just please close the VS Code and reinstall it again. Okay, perfect. You are at the folder, then you are at this the current folder. Now, just let's wait a couple of seconds. Okay, then Sophie, again, Control Shift P. And Julia, start the first one. Control Shift P. Choose the first one. Yeah. Let's try again. Install path solver. Okay. Now right square bracket again. And type just activate BNV. Okay, now again ST, let's check what we have here. So we have 4, but again don't have path solver. Please type again add path solver.
Again, it's
Again failure. I don't know.
okay. Maybe I can just search.
Yeah, that's perfect, and yeah, because in some computers, in my I didn't have any problems in downloading. But these are some technical errors which I don't know what to do, so we can search and so Ani installed, right, Ani? Okay, if others are doing this parallelly, just let us know what you have.
So ChatGPT suggests that you have to add, you have to build this path solver, but I'm not sure.
Okay, Ani is using chat.
Yeah, I just pasted the code in the chat.
Okay, should I run this code?
Wait. Ani, what you are saying is another way of installing the package, but if please just whatever error, all these rows of errors, just go to ChatGPT and ask what's happening. Maybe it can solve. So you are using 4.
Yes.
That's fine. Just copy past all the rows of error. Yeah, everything. Yeah, perfect. It's fine. Go to ChatGPT and paste. Seems to be related to failure in downloading. Here's how you can do. Your version is outdated. What does it mean? I'm not sure your Julia version.
Yeah, it's up to
Is
date
your
version.
what version you are using?
How can I check this?
Go to
Yeah,
you are using the 1.11.3.
yes.
That's fine. Go again to using PKG, rebuild the package.
Should I run this?
Try. But you can run in PKG this. Control C. And you can do it in Julia. Yeah. Row by row. No. Control C. Sophie, first row. You cannot run these 3 lines
Okay.
like simultaneously.
Okay.
Step by step.
Okay.
Using PKG.
Should I be in VNV environment?
No. Whatever ChatGPT is recommending, it's a purely Julia thing.
Okay.
The last one and the hardest one. Can you go? The following package names couldn't be resolved, not found in the project or manifest. Okay. Can you go again to suggest go down? Down. I can't see any. It's saying if the default is falling, try installing directly from GitHub. Can you try this GitHub? Yeah, this one.
Or it's again error.
Again the same error. I think we need to. Okay, then let's try other thing, which is also necessary. Maybe it will help. Sophie, now this path solver is not enough to deal with mixed complementarity problems. And if you go to GitHub page of Dynar, there is some instruction on how to get the license to path solver. If you open this and go down, and I recommend you to go through these things. Go down. It's very useful guide. Go down. Yeah, this pipe license. What it says, Dynar uses the path software provided by Path Solver GL to solve perfect for signed models with occasional binding constraints. In order to use it, you need to add the free license available. There is a link in your file. For user Windows, for Windows users, there is a guide on how to get this pipe license. I saved this path license in 2 folders, in my current folder when I'm running these codes, and in this Julia directory called in config. Let's go step by step and do this. Okay. Can you open in other windows this a link to license? Yeah. Now, Sophie, go back to GitHub. Here, go a bit down. And there is a guide on how to do that in VS Code. So we need for Windows users in VS Code. Anya, can you check for Mac users? Is it the same, or I think you can follow the same steps, but if there are some specifics for Mac users. Under Windows in VS Code, I guess it's general for both Windows and for Mac users. Okay, now in VS Code, go a bit down again. So we can, okay. So what it says, go to File, Open Folder, and go to File, New Text File. Okay, can you open like, yeah, perfect, parallel this. Please. Now, Sophie, you are at some directory. Now, open file, new text file. This one. In the new text file, type, go down and see what it's in VS Code, go to file, new text file, and in the new text file, type, no, just in GitHub, go a bit down so we can see full. Yeah. That's fine. In the file type, copy paste this env5 license. No.
Not this one?
In VS Code, in the new text file, can you follow these rows? In the new text file type, just copy paste env5 license string, all these things.
Oh, okay.
Copy and put in the here, yeah. And license number provided in the above link. So you need to now copy paste that number instead of license number provided in the above link, instead of text. Now go to license, the second one, yeah, here. And the license number is 28, yeah, all these things. Yeah. Then what it says, go to file, save, save, save as.
Okay.
It's a save as. So in my case, I followed all these instructions and okay. Now in the field file name, write startup.gl. Here.
This one?
No. In file name,
Okay.
name it startup.gl. Save. Just keep.
It should be plain text, right?
No. Keep. It doesn't say anything. Just save.
Okay.
Okay. Now, Sophie, go to your VS Code. Just make it bigger. Okay. Can you close this startup? And I need to see the directory you are on the left-hand side. So we have startup GL. Can you open again that? And on the right-hand side, there is a run button. Yeah, can you run? Okay, I think that's good. Now, again, go to VMV directory. Let's install path solver again. No. Just delete in the startup GL. There is a square bracket on the right hand side. Go right.
Okay.
Yeah, just delete that. Okay. In VMV, you can close this. Just close that. Yeah. And again, type ST. Try again. Add path solver.
Yeah, it still has some problem.
Okay. Go up. Let's see the error. Maybe we'll figure out, but I'm not sure. Maybe you have some Windows problems. It can be a result of some Windows problems. So what it says, unable to automatically download install artifact half solver from sources listed in half solver. You are typing it correctly. Okay. Sources attempted. Go down. Mm. Again, go down. Ensure installs. Okay, again, REPL also open here. Can you copy again this and go to copy pasting ChatGPT and Ani, you have suggestion? It's working. Okay.
Sophie, can you just type this command that I have pasted in the chat, the last one?
Okay. You mean this?
Okay. Yeah.
No, the brackets, you don't need brackets. Okay, Sophie, please, let's.
Okay, I will just delete this one. Oh,
Okay, try. I don't know.
Or the one before, the previous one.
Okay, not to lose time. Please again copy the error from add installation. From here, go down, up a bit, yeah. Here, copy, go to ChatGPT. It's copying, Sophie.
okay. I guess it's not.
No, it's copying. That's the feature of Julia.
Okay.
Yeah, say so this so just paste here and write that explain what's the error. In non-technical words, explain what is the error. In non-technical words. Okay. The error message contains. Correct output. How to fix the issue? Go down. Yeah, that's we tried this. Go down. Down, Sophie. Download the binary matching your systems.
Can we use this manual download?
Yes, please open this. Maybe what version of it says about some version. Like, I didn't
For
get.
Julia, I have the latest version,
Yeah,
and for VS Code, I guess it's the latest.
again the latest version. Yeah. Okay, let's see what's saying.
Oh, it has some problem.
So Ani just said me that she's successfully running. So the only problem with with Sophie's case is that we don't know. It's a technical error. It can be error of Windows installation. I remember if Aisha is here, she can confirm that sometimes we get this kind of error because of the Windows installation and all these technical things. So the IT guys need. So the IT guys should check these errors. We can't do that.
Okay, so can I ask anyone at CBA?
Yeah, we can ask IT guys at CBA to fix this. For example, in my computer, it's running perfectly well. Ani just did all the steps we are doing with Sophie, and she's able to run the code.
Yeah, also, I guess I have some kind of internet connection problem because I'm not able to open this GitHub webpage.
Might be, yeah, that might be. So the IT guys need to, we need to address this question to IT guys. So it's out of our control. It's a technical issue.
Yeah.
I don't know what to do. It's very super technical IT issue. So at this stage, Sophie, thanks a lot for. So you did everything well, and everything is perfect, except that we got this technical issue. But we are happy that Ani, in Ani's case, everything is fine and good. And I would like to ask Ani to share. And at the point we stopped, Ani just share and show how you install the path solver, and then we will proceed to the solution of them.
Yeah, so Sophie, Can, we will deal with that issue on Monday. Yeah, we will go to IT.
Awesome.
Okay, so as you can see from the terminal, this
The only different thing is that
I have a different theme. I have chosen lilac with white colors. So I hope it's not an issue for you to follow me. So I have, as you can see, I've tried to activate packages. At first it gave some errors, but then I again activated this virtual environment by this activated VNV command, and then I typed st to check the status, and then I added the packages dinar, data frames, plots, dates, path solver, and you can see all of these packages have been installed successfully. And then I just ran this code and
Ani, thanks a lot. So let me add here something. I asked Ani just to check, can she run the code which I sent? And it's running very well, but we will go step by step analyzing the code. At this stage, so if you followed what Sophie did, Ani did exactly the same, except that when she did add path solver, it worked well. Okay. And Ani, can you go again to your DNV?
No, sorry, Haikas. So ChatGPT also said that it might be a problem with the internet. So it give me some code, and if this code fails, then yeah, it's problem related to internet. And yeah, I guess this was the cause.
Yeah, it might be, yeah. But we are using the same connection.
Yeah, I
she's in the campus.
Sophie, you are muted. You are muted. Sophie, you are muted. We can't hear you.
can you hear me now? I am using CBA guest.
Okay, we are using CBA corporate. Okay, I guess what we are using.
Maybe because you're in campus, that's why it gives some.
Ani is using CBA guest. Yeah, I'm using CBA corporate. But okay, then we can even after seminar talk about this. Now let's do the further steps. And if you repeat and online audience, and after this seminar, if you watch the video and repeat exactly the same steps, you will have everything ready to run, and you will be able to replicate Oxford paper results. Now, Ani, go down. Down. Introvert. Go down. Here, Ani is in VNV. Type again ST, Ani. So you can see that Ani has path solver, which is necessary to solve mixed complementarity problems. So Dynar itself has a lot of packages inside of Dynar to do the stochastic simulation, to do a bunch of analytical work, but to solve the mixed complementarity problem, we need to have path solver. That's why we are installing it here. Now, these are all the steps which we need to make this thing is running. Now, can you close the plots? Close the plots and open. Yeah, I sent you. Yeah, I sent you the two files. The one is mod file, which is standard Dynar file. Again, in Julia, we are using mod format similar to MATLAB. And also there is a Julia file, which called ENDOCRED Simul 2020 GL. This is Julia file. And let me go now at this stage, I can share. And so then I after when we go through the code, I will ask you again to run, and then we discuss. Then we will discuss the progress. So the background of mine and Sophie's is black, and for your eyes, the black is better. I think the black is better than the white. Ani is using Ani. I don't know how to change, but okay, there is a way to change here in settings, times, right? And the color. Okay. Okay, you can choose whatever is convenient, but especially for me, for not pressing your eyes, you can use this black thing. Okay, what I sent to you is called ENDOCRED Simul 2020 GL. This is Julia file, and the format is is GL. So Sophie created this startup GL, right? I have the same. So this is the GL, Julia format. And our model code is written in mode, quarterly US Euro area ENDOCRED 2020. And you can run this code, this mode, in MATLAB as well. It's working perfectly well. So this is the version of the code of the model the Ani which presented in the morning, and how it looks like. If you go through the code, it has like how many rows? Yeah, more than 1,000 rows. It's quite big, but we have models bigger than this. And let me here show you some specifics also of the Dynar environment, some useful tools which can make your work and your life easier, like Dynar macro processing. I will explain how it's working, and also some switches. So within the same, for example, we have a code where we want to have the nonlinear Phillips curve, and the code where we need to get rid of those nonlinearities and preserve only the linearities. So there are not to create two different mode files, one with nonlinear features and one with linear features. We are using these macro processing things. And first of all, let me start describing you these Dynar notations and how these work. And then at the next stage, we will go through the model environment and the model equations. First, guys, we are using these define notations, and define length 2 equals to 2, and let's say length 40 equals to 40. So why we are using this? Imagine that that you are constructing 10 years in interest rate, right? And how it should look like 10 years interest rate using the for example, the expectation hypothesis of the interest rate. We can call it RS, for example, 10 years, right? And construct this 10 years interest rate. And so this version of the model is a quarterly. So it's calibrated to match the quarterly frequencies of the data. And to do that, let's say we have RS, which is the nominal short-term interest rate, right? And to construct the 10-year interest rate, we need to do what? RS, current RS, plus RS expectation, 1 quarter ahead, plus RS, let's say 2 quarters ahead, RS 3 quarters ahead, and go manually, step by step, up to RS plus 39, and then divide all this thing by 40, right? This is the way of how to get the 10-year interest rate out of the short-term interest rate using the expectation hypothesis of the interest rate. Not do manually all these things, and there is a probability like to do some mistake, let's say, right? We are using this length 40, define length 40, and let's search. You can use Control F, like highlight whatever you want to search, Control F, and here you can see that we use length 40 in 5 places of the code. Okay, let's start it. What we have here, US 10-year expected policy rate. Okay, the entire code getting that 10-year interest rate looks like this simple and beautiful notation. Instead of manually, let me copy paste that. Guys, instead of manually get this equation of the 10-year interest rate by writing all these 40 parts of the long run interest rate plus 5 plus, okay, it's a huge long run thing. So Dynar allows us to use this so-called macro processing to get this, okay? And how it works. So we are saying that RS 10 US equals to 1 divided over length 40, which is 40, right? 1 divided by 40. And what we are saying for I, starting from 0, going to 40 minus 1, that means I notation subindex, starting from 0, going up to 39, okay? RS US, so I subscript, which means use 0, then 1, then 2, up to 39, sum it, okay? So we are using this notation for I from 0 to 39, summarize all the interest rates, all the short run, short interest rates starting from 0, from current time up to plus 49. Okay.
These are the increments, right? Like we are adding this incremental, accumulating.
Yeah.
And then averaging this sum.
So yeah, so this technique, this Dynar, yeah, it's automatically generating that series, and this is very useful Dynar tool. So in your work, in your everyday work, and you are dealing with these kind of issues, you can use this, and the probability of getting the error using this technique is very low compared to the probability of error when you need to put to type everything manually. So this is the first one, technique, and very important and useful tip. The second one is for, as I said in the beginning, let's say you want to use no linear. specification of the Phillips curve versus linear specification of the Phillips curve, right? In a simple, very simple notation and in a very simple environment, right? You will have two mode files, one with nonlinear specification and the second with the linear specification. And you run two different codes and get some results, save that results, and kind of use it for different purposes. Let's say, for example, why we are using the linear representation of the models when we are doing, for example, the filtering or estimation for these kind of purposes, right? And for more serious analysis, let's say for building the policy scenarios and these kind of things, nonlinear features of the analytical framework are very useful, and we need to think through the scenarios from the and think about the issues through the lens of the nonlinear framework. As for example, Ani was talking about different parts of the Phillips curve. Let's say the economy is overheating or it's a crisis, and all these nonlinear features are very important to look. Okay, now guys, let's we use this feature of the dynar in two parts. Let's look at the Phillips curve. Okay, I'm using this. Define nonlinear PC equals to 0. When we put 0, that means when we put it 0, that means that we are operating in a nonlinear Phillips curve environment. If we put instead of 0, 1 or 5 or whatever, except the 0, the code switches to the linear Phillips curve. And how we use this nonlinear? Okay, at the beginning, before starting declaring the endogenous variables of the model, we use this define nonlinear PC equals to 0, right? And then we use this let me go to the model block and show you here. Let's look at the Phillips curve. So we have Phillips curve for US, and we have Phillips curve for Euro area. We use the same technique for doing for both countries. Now, how this looks like? So we have inflation, which we define by US. This is quarter-on-quarter annualized inflation. So it equals to expectation of the so some parameter lambda 1s equals times expectation of the inflation, and 1 minus lambda that parameter times the lag of inflation. So we are saying here that both the expectation of the inflation and the previous development of the inflation, previous 4 periods development of the inflation, is pi for US is a moving average of previous 4 periods inflation. Then here the macro processing is coming. What we are saying, we are using these notations. Nonlinear s equals to 0. We are saying use this specification, which is lambda to US times the nonlinear component of the representation of the Phillips curve, which means that we have some upper bound for the output gap, which is 5, and the effect of the output gap on inflation is kind of increasing exponentially when output gap is converging to close to 5%. So Ani was talking about this specification. And else, we are saying if nonlinear PS equals to 0, when we put this 0 at the beginning, when we are defined nonlinear PC, use this. Otherwise, use the simple representation of the Phillips curve, where the effect of the output gap on the inflation is just linear. So this lambda 2 US times the output gap. Okay. And these features of the dynar, I think, are very important. Okay. So we are kind of closing the nonlinear part and whether to choose linear or nonlinear here. Then the rest part of the equation where we have the exchange rate affecting the inflation, because in this setup of the two-country ENDOCRED, so we are operating in a open in a two-country environment where exchange rate matters. Do you have any questions related to this part? Or maybe you have other ways to make our life and this.
I just,
Yes.
I was wondering if we can like construct this iterations without this defining the length. So if you go to the iteration part where you define the long-term interest rates, like instead of having this length 40, just type
40. Yeah. I tried that. It works. Yeah, but just for also what our purpose is. As an economist, as we are working on the codes, to write down these codes in a way to be very user friendly and useful for colleagues. So every time I'm trying to write these codes, I want to make sure that when I pass these codes to my colleagues, they can figure out all this crazy stuff very easily, and don't kind of spend a lot of time on figuring out. Of course, not always I can afford to do that because of the lack of time and other issues, but I'm trying to do that. And this system of codes of the Oxford paper is very close to that standards. So we need to set standards, so we can publish these codes and everyone can have, for example, the free access to codes and run everything easily. And if they want to change something or add something, it will be very convenient for them to do that. Okay. Now. So in a similar way, we have this kind of notation also in aggregate demand equation. Now, as you know, we kind of starting to declare the model blocks in dynar, and it is common to all different. It doesn't matter you are running the dynar in MATLAB or Julia or in other software. It has some standard blocks. And the first standard block, you can operate the code without this, but it's standard and it's requirement to have the declared in a proper way the endogenous variables. First, the endogenous variables of the model. You can start by typing var, var, and then declare the endogenous variables. So here I have 3 columns, and I suggest you always to use this kind of format, which will make your life much more easier. You need some time to spend on that, but for example, let me explain what I mean. So we have dinar notations. So we define, let's say, pi US, y US, r as US, okay, which we'll use in the model block, in the reporting block, in other blocks of the code. Then we can make LaTeX notations. These LaTeX notations are very important for if you, let's say, if you want, for example, use the results of these codes and write down your LaTeX node, write down the paper or whatever you are doing using the LaTeX or overleaf, these kind of things, you can use this LaTeX notation. And after running the code, Dinar automatically can create the LaTeX code of your equations, of your calibration, whatever. Then explanation of the defined variable. So if you have bigger models and it's not always possible to remember all your Dinar notations, here you can use explanation of the defined variables, like this is the standard and usual command. Long name US, for example. We are defining pi US as a quarter-on-quarter annualized inflation, US and euro area. Then Y underscore US is for US output gap, euro area output gap. When you are writing the codes, I recommend just spend some time. It will not take so long. Just explain what all the variables mean. So in a case when you need to come back and understand what each variable means, it will be easy for you. Okay. So what we have a lot of things here. We have expectation, we have real neutral rates, gap of the real interest rates. We have the moving average of inflation. We have the credibility here, and there are some also things which serve kind of reporting things. For example, the cumulative output gap. It doesn't affect anything. It doesn't affect the dynamics of the model, which means that they are not state variables. But for some tasks, you can create these kind of things. For example, cumulative output gap, and use them for reporting purposes. Okay. Real exchange rate gap again. Then one of the important blocks of this model is kind of build the long run interest rate. Build long run interest rate out of market interest rates. For example, for US, you can, and for other countries, you can easily find the interest rate on different maturities. And here as I showed you before, using the expectation hypothesis of the policy rate to build the long run interest rate. And other component of that theory is the term premium. So we decompose inside the model the long run interest rates into two components: the expectation for the entire path of the short run or the policy rate, and the other component, which is a term premium. Okay. So we have all these term premiums. What else? Yeah, here we are using the information from 1 year, 2 years, 3, 5, up to 10 years interest rates. And then we are building the long run interest rate, which is kind of weighted average of the different interest rates, and based on our observations and our understanding of the assets and liabilities of the households, and okay. So, and this long run interest rate then goes and affects to the aggregate demand conditions of the economy. What else we have? We have the unemployment block. Here we are using the open law and link the output gap and the unemployment gap. And we have a bunch of serially correlated shocks, which help us to design the scenarios. Okay, all these probabilities, probability of low inflation regime, probability of high inflation regime, so on. I presented this, and I will show you how we write down all these features and all this system into Reinhard, Julia, right? Yeah, and also some other. So this for I guess a real interest rate for 3 years, 5 years, so. And then after each block, Dynar requires you to put semi-comma. So you start with var, which is for declaring the endogenous variables here. So our list is very long. And then you are closing this block by typing semicolon. You can use this double slash for the comments. And what we have, this block defines exogenous variables of the model. So how to define the exogenous variables of the model is typing var exo, okay? And what we have EPS. Again, this is the first column is Dynar notation. Second, I'm using LaTeX notation and the explanation. You can, what is necessary for the code is, of course, this Dynar notation. You can just remove LaTeX and explanation. It will work perfectly, but for convenience and for matching the better standards of doing the modeling and kind of make all these codes user friendly, always I recommend you to use also the explanations. So we have a bunch of shocks which makes model and also the process of scenario building richer. So depend on the historical period and depend on the situation. we will use different combination of shocks to address some policy equation and to build the different scenarios. Okay, we have output gap shock serially correlated. We have inflation shock. We have simple IID inflation shocks and output gap shocks and bunch of different other shocks. Okay, then putting semi-comma, we are closing this block and starting to declare the parameters of the model. Here, the notation is just parameters, and we are starting to declare the parameters again. I am using LaTeX and the explanation of the variables. For example, lambda _1 US is for parameter on the lead in US inflation equation in the Phillips curve. Okay, and similarly, we are doing for all other parameters which we are going to use in the model. And of course, during DIM, when we look at DIM model, we come back again to these parameters and to calibration of the parameters. First of all, DINAR requires to declare all these parameters, and then again semi-comma. Then we start calibrating the parameters of the model. This block calibrates the parameters. So we are, it's necessary to calibrate all the parameters which we define in the parameters block. Okay. We will come back to look at some at values of the some parameters, but we are using this calibration based on previous analysis and our previous experience of looking at these parameters. Okay, then the model. Okay, here we finish the calibrating the parameters, and the next block is the model block. We just define model and semi-comma. And then at the end of the block, we use end semi-comma. And inside the model block, we are typing the model equations. And this notation is used to name the model equation, okay? Again, I recommend you to use these notations. So here, what we say that this name this equation as a US Phillips curve, and then name this equation as Euro area Phillips curve. Okay, so we looked at this equation where we are using this the DINAR macro processing feature to declare should we need linear or nonlinear representation of the Phillips curve. Then I think for all the model equations, we are using these notations. So we have real interest rate for US and for Euro area. And then we decompose. So these parts are pretty standard, and we use this declaration in almost all type of QPM types of models, and which we use for policy analysis. Then decompose the real interest rate into the trend component and gap component. So we say that some part of the real interest rate is driven by more persistent and sustainable components, which we call trend, and we have some understanding of the long run neutral interest rate, which is RR bar TAR, and we are saying that short-term real interest rate trend has some persistent in it and goes, and in some medium run perspective goes to more fundamentally defined value of the interest rate. Then there is this component, which is the difference of real interest rate and long run interest rate. And then some definitions. We are defining 1 year moving average inflation, which is the average of previous periods inflations. Then we are defining some price levels. So all these are not fundamental or so-called behavioral equations of the model. If going, if you, we can of course divide or name the model equations to divide into different categories. So the first ones are behavioral equations, which kind of shows the fundamental economic relationships between variables. Let's say it's a inflation equation, Phillips curve, or the demand equation, and there are some equations which we can call I'll name it just where we are using for defining some variables. Okay, then this is also Ani, you can jump in and interrupt if you want.
Definitions.
Definitions, yeah. The other block can be definition, just.
And also there are some differences between Euro area and US. For example, we have this that in case of the Euro area, we have this output gap, world output gap, affecting the inflation, whereas in the US we don't have that effect. So this is like one difference between Euro area and US. Also, in case of Euro,
that's good. Let's show that. Yeah, that's good, Ani. And let me show that, and then we can continue. Yeah, Ani is talking about this US output gap and Euro area output gaps, right? When in Euro area output gap equation, we can see here the US output gap affecting the Euro area. So, but not the vice versa. Here you can see that so all these types of equations and how to include this or that variable in the equation is based on the our understanding of the economy and the economic theory. Yeah, that's a good point, Ani. And the next, what you wanted to say?
That Euro area operates with reaction function and US operates with loss function. This is one stark difference between those countries. And also we have differences in calibration as well. So in case of the Euro area, I guess the initial value for credibility should be lower, right? Than in case of the US. And also we have these the kappa parameter that I have talked about. This is the coefficient of the inflation bias, right? And for different countries, we would have different values for that. For example, in advanced economies they have more relatively anchored inflation expectations and relatively higher credibility. This kappa would be lower. But in case of advanced emerging economies or like such as dollarized economies, this kappa high, which indicates the coefficient of the positive inflationary bias, it would be higher. So yeah, this is how we operate with calibrations. So
yeah, that's perfect points, Ani. And what Ani said, I will go and show you how we declared it in the model block and in the calibration and parameterization of them. So you remember from presentation, from Ani's presentation, that we have two inflation regimes, and we are seeing that there is some probability that countries can end up in the high inflation regime, or they can end up in low inflation regime. And all these considerations about the probability of being at the high and low inflation regime affects the formation of the credibility and inflation expectations So what we have some probability US high def high. So probability. So we are defining current by this US high def high, how the current inflation in the US is relative to the high inflation regime. Okay, and low means how the current inflation, current 1-year inflation, how it's relative to the low inflation regime. And high inflation regime, we say that 5% and high, when inflation is coming closer to 5%, it's a high inflation regime. And when it's 5%, we are saying that US in a high inflation regime, okay? And there is one lower bound of the inflation, which is currently is -1 in this in this calibration. We are saying that it's a low inflation regime of low inflation trap. So these parameters here, these are parameters. Let's find the calibration. It's a 5 for high inflation regime and -1 for low inflation regime. In your simulations, depending on what issues you are looking, you can change this calibration. And for example, in some cases, say that okay, I'm not. I think that when inflation is closer to 4% or closer to 7%, for me that's very dangerous. Or you instead can think about the low inflation trap as let's say 2% of deflation or whatever. Now, the probability of being at the high or lower inflation regime. Again, here we are using some dinar notation. That's these 4 expressions starting for USPI. And let me explain. So these equations are different from what we see up to this point. And what it says? It says that when US high def high, which is this thing, is higher than 0, okay, which means that the current inflation is higher to this thing, or it's close to high inflation regime, you take the value of US high or probability of US being at the high inflation regime equals to this expression, okay, where so Ani was showing this this expression, and but let me explain what does it mean. But when US pi def I is lower than 0, which means that this expression pi for US is lower than this part, which means that the current inflation, so the intuition is that the current inflation is far from 5%, okay? It's close to target, let's say. Calculate the probability of high inflation regime as 0, okay? So this means that if US pi def is higher than 0, take this expression. If it's lower than 0, this expression. Take the probability of being at the high inflation regime as 0. And the same for probabilities of the low inflation regime, okay? In the previous versions of the ENDOCRED, we had just what we had just
In the previous version?
Mm-hmm.
Instead of having probabilities, we used to have this central bank performance index. Which is basically the idea is similar. So this central bank performance index, it's also used to be defined by these error terms. And if the error term conducted in case of the
So these are error terms. These are error terms.
Yeah. So if we are making high forecast errors, predicting that inflation will converge to the target, then that means that the performance of central bank declines, and vice versa. That's how it was defined. But sometimes, so in this case, we define credibility in a way that it can be depreciated in both ways. So whether inflation goes higher than the target or falls below the target. In both cases, we lose credibility.
Yeah, that's good. So here, and we can explicitly talk about the possible probabilities on being at the low or high inflation regime, and that this directly affects on the formation of the stock of the credibility, and as well as effects to the inflation expectations. Now, what Ani was saying is that this performance index, but one minus, but the performance is the opposite of the probability of going away from the target, right? So then we have these two probabilities being at the low and high inflation regime, and one minus these probabilities is kind of showing that central bank currently is performing well. It's accumulating the credibility. But when there is some probability of being at the high or the low inflation regimes, central bank is losing the credibility, right?
So this thing in the parentheses and this 1 minus probabilities, we didn't exclusively define it in the code, but it's the flow of credibility that I showed in the presentation. And the stock of credibility builds upon its historically previous values, and it is positively based on the flow of credibility as well.
Yeah. So what we say that credibility is stock, right? It has very big persistence. Central bank is accumulating the probability, the credibility by designing policy in a way to reduce the probabilities of being stuck at the low or high inflation regimes, right? So it depends on the if central bank doing its job well and permanently, consistently, it reduces these productivity probabilities of being in low and high inflation regimes and contributes to the accumulation of the credibilities. Then, what is other modification of this version of the ENDOCRED is explicitly having these probabilities affect on the formation of the inflation expectations. Here you can see that in inflation expectation equation, we have these, again, low probability and high probabilities. But the probabilities are always the positive numbers, being probability of low inflation, positive, probability of high inflation is positive. But what is different here are the calibration of these kappa parameters. Annie said about this. And for high inflation regime, of course, these kappas, we calibrate positive, and for low inflation regime, we calibrate it negative. Let me show you this to you. Yeah, kappa US high is a positive number, and kappa US low is a negative number. And what does it mean? When there is a probability of the high inflation regime, it means that it negatively affects on the formation of the inflation expectation. So the economy is in high inflation regime. If it sustains, it increases the inflation expectation. But on the other hand, when the economy in a low inflationary regime, it further reduces the formation of inflation expectation. Let's think about the low inflation, being stuck at the low inflation trap, right? So the economy is permanently in the low inflation trap, and formation and inflation expectation are always stuck at the values below the inflation target. Okay. So this is the other feature of this new version of the ENDOCRED. Then what we have here is we have some definition of changing the interest rate with the cumulative output gap. As I said, we are using this kind of looking at the cumulative output gap is kind of look at the trade-off of different policies, and it's useful for reporting. Then what we have here also, let me explain this very shortly and probably stop here. And tomorrow we can continue. The output gap equation, where again we're using this dinar notation to choose either we want long-term interest rate to affect the aggregate demand conditions or the short-term interest rate, right? Again, in the beginning we have long-term prem defined, right? And when it's zero, switch the long run real interest rate and term premium in output gap equation. To switch to the short run interest rate gap, set just equals to 1 or anything else except the 0. Okay, you can choose here, just change here to 1 or other variable. It will switch off the effect of the long run interest rate, where here in the long run interest rate gap, we have also not only the expected path of the short run interest rate, but also the term premiums. Or then we can use only the short run interest rate. So in textbook or in simple models, usually people look at the effect of the short term interest rate, but have much more better view of the effect of the policy on the aggregate demand conditions. I think this we need to use the long-term interest rate, and also because economies are open, the real exchange rate effects on the aggregate demand condition, and for euro area, as said, also the external output gap effects. In this case, the US output gap effects on the euro area's output gap. Okay, then let me stop here. If you have some questions, we can discuss, or from this point, we can start tomorrow again, 10 a.m. To continue and now go through to do the simulations and replicate the Oxford paper results.
Thank you, Christian. So, do you have any questions? Do we have any questions from the audience?
Okay, thanks. It's exactly 2 p.m. in Yerevan time. We can stop here and continue tomorrow. And please, guys, use this period. Just follow the video and install your Dynar Julia. So tomorrow you can run by your own in your computers the codes.
Hi, Cass. Thanks for getting all this stuff ready. I can see that we're going to make a lot of use of this. Okay, so Sophie, Cassie, we gotta get this, so that we could roll it out and teach to everybody, right? Because anybody can now. Bob Tetlow, for example, at a conference in Georgia about a month ago, when he was talking about how they do things at the Fed, he was referring specifically to solving mixed complementarity problems, okay, on nonlinear models with interesting things like occasionally binding constraints. And he said the Fed is the only place, central bank, that does that. Okay, so and of course I corrected him and said, well, you should read about it because the Central Bank of Armenia is doing it. I'd only want to say one thing, and it's going back to the pointing out the policy errors. That basically the big central banks made at the beginning. And the question is why? Why? And I think, if you believe Mervyn King, he thinks it's because they were infected by these crazy ideas, by these fads in academia. And I think we should actually take those things, that criticism seriously. And so when you might ask, one of the problems in those central banks is they still think that answers come out of models like academics do. And so I just want to emphasize in developing this ENDOCRED model, we've been developing them for years, and not one has ever been put into production. And the reason is that the purpose of building these kinds of models is to help us develop intuition and to look at empirical evidence more broadly and so on. So I just wanted to say, let's please not let this turn into a game where basically people think that, we can estimate everything and the computer can tell us what the answer is, because that infection, unfortunately, would be the worst infection we could possibly get. So now that you have the tools to investigate these kinds of models, now is the time to apply them on lots of different countries. And it's really through that experience that I think of applying it to different countries that will truly understand what kind of insights these models have. So Annie, hi Cass.
Yeah.
Thanks for all the efforts that you guys have put into this for us. I think we owe you. And of course, Michelle, has been the guy that has, developed all this infrastructure. And I'm sure that he will be very happy that it is being used and deployed in a way for the social good, which is basically the thing that always motivated him. Okay, so thank you for all your work today, and happy Saturday. Sorry, go have fun. Enjoy yourself. It's a beautiful sunny day out there right now.
Yeah. Thanks. See you
Thank you.
tomorrow at 10 a.m. again.
Thank you very much. Have a nice day. See you tomorrow.
See you. Have a nice day.